Right now, at this exact moment, there are 356 paper claims for every single physical ounce of silver sitting in a COMEX vault. 356 to 1. Let that land. If even 1% of those paper holders demanded delivery, not sold, not rolled over, just asked for what they already paid for, the entire system would be out of silver before lunch on a Tuesday. And yet the price is sitting right around $32 an ounce. You're watching this because the mainstream financial press won't show you this number. They'll show you the ticker. They'll show you the chart. They won't show you the ratio behind the chart, because once you understand the ratio, the price action makes sense, and the story it tells is not a comfortable one. Let me show you what I mean. Pull up the COMEX open interest data from the last 30 days. As of the most recent filing, total open interest in silver futures contracts represents approximately 1.04 billion ounces of silver. That's billion with a B. Now pull up the registered silver inventory, the silver that's actually available for delivery, sitting in approved vaults right now. That number is approximately 65.2 million ounces. Do that division. 1 billion divided by 65 million. You get to 16 to 1, and that's just the registered category. If you expand to the full eligible inventory, which includes silver stored in COMEX warehouses, but not technically available for delivery unless the owner consents, you reach that 356 to 1 ratio that nobody in the mainstream is talking about. This is not a conspiracy theory, this is math, and the math doesn't add up. But that's not the part that should concern you. The part that should concern you is what happened to the Shanghai Premium over the last 14 trading sessions. While the COMEX paper price has been range-bound, chopped between $30.50 and $33.40, going nowhere, the Shanghai Gold Exchange's silver equivalent has been pricing physical metal at a persistent premium of between $1.80 and $2.40 per ounce above London spot. 14 consecutive sessions. Not a spike, not a one-day anomaly. A sustained, widening gap between what paper says silver is worth in the West and what physical silver is actually trading for in the East. Paper says one thing, the vault says something different. And when you start tracking where that physical silver is going, who's buying at that premium and why, the picture gets a lot darker before it gets clearer. Now, before we go any further, if you're watching this and you're already stacking, if you've already made the decision to hold physical metal outside the banking system, stay with me, because what I'm about to show you in the next section is going to validate every instinct that brought you here. And if you're newer to this, if you're still trying to figure out whether the warnings you've been hearing about silver are real or noise, this video is exactly for you. Welcome to the hidden economy. The real story is never on the surface. If you're not subscribed yet, fix that right now. Hit subscribe and turn on the notification bell, because the information I'm about to walk you through is the kind of analysis you will not find on Bloomberg, you will not hear on CNBC, and you will not read in the Wall Street Journal. They are not confused about what's happening. Wall Street is not confused. They know exactly what this means. The question is whether you do. Now let's talk about what no one is saying. The COMEX warehouse report, that's the daily filing that shows exactly how much silver is sitting in registered and eligible vaults, has been flashing warning signs for 47 consecutive trading days. 47 days. The registered inventory, that deliverable silver, has declined in 31 of those 47 sessions. Small decrements, 200,000 ounces here, 400,000 ounces there. Nothing dramatic enough to make headlines. But add it up across 47 days, and you've watched 11.3 million ounces quietly leave the registered category. That's 11.3 million ounces that were available for delivery, and now they're not. Where did they go? Some reclassified to eligible, some moved off exchange entirely, but the pace of decline is accelerating. In the first 20 days of this 47-day window, the average daily drawdown was 180,000 ounces. In the last 14 days, that average is 390,000 ounces per day. The rate more than doubled, and the price hasn't moved. This number doesn't exist in a fair market. In a fair market, in any market governed by basic supply and demand, shrinking deliverable supply with stable or growing demand means rising prices. That's not ideology. That's not a political view. That's how markets work. The fact that this supply is shrinking while the paper price sits flat is either the most extraordinary coincidence in commodity market history, or it's something else. And then something strange happened to the vault numbers. On the night of March 6, 2026, a single COMEX filing reclassified 13.1 million ounces of silver from eligible to registered in one move, overnight. No announcement, no press release, No analyst coverage the following morning, just a quiet restatement that doubled the registered category in a single entry. 13.1 million ounces, moved, at 3 a.m., filed before markets opened. Ask yourself, why would someone need to dramatically inflate the appearance of deliverable supply at precisely the moment that supply was tightening most visibly? The answer to that question is Act 2. To understand what we just saw in that March 6th filing, you need to understand who controls the silver market and how they've controlled it before. This is not the first time this playbook has been run. Same playbook, different decade. Let's go back to 2011. Silver hits $49.51 an ounce on April 28, 2011. It's the highest nominal price in 31 years. Physical demand is outstripping supply. Coin and bar premiums are running 15 to 25% above spot. The U.S. Mint has already suspended sales of Silver Eagles twice in a 4-month period due to blank shortages. The Shanghai premium is persistent. Sound familiar? What happened next is documented. The CME Group, the company that owns and operates COMEX, raised margin requirements on silver futures 5 times in 9 days. 5 times in 9 days. From April 25th to May 5th, 2011, the initial margin for a silver futures contract went from $11,745 to $21,600, an 84% increase in the cost of holding a leveraged position deployed over a single week. The price of silver went from $49 to $33 in the same window, a 33% collapse in a metal that had been rallying on genuine, documented physical scarcity. The premium held through the entire dump. That's the tell. That's the signature of a paper-driven price suppression event. Physical silver at coin dealers didn't drop 33%. It dropped 8%, because the people buying real metal understood that the paper price and the physical price had just been forcibly separated. The gap they created in May 2011 was artificial, and it closed, eventually, but not before millions of retail investors panic sold their paper positions at the bottom and handed that paper to institutional buyers who understood exactly what they were doing. Once is accident, twice is coincidence, 3 times is policy. Now here's where it gets interesting, and by interesting I mean disturbing. The entity most associated with large, concentrated short positions in silver on the COMEX, the entity that has held, at various points, a short position representing more than 25% of annual global silver production, is JP Chase. This is not an allegation. In September 2020, JP Chase & Company entered into a deferred prosecution agreement with the U.S. Department of Justice and paid a $920 million fine. $920 million. The DOJ's own filing described years of spoofing and manipulation in precious metals futures markets, including silver. Former JP Morgan traders were convicted of racketeering, RICO charges, the same statute used against organized crime. So we're not speculating about whether large institutions have manipulated silver prices before. We have a court document and a 9-figure fine confirming that they did. But that's not the part that should concern you. The part that should concern you is that after the fine, after the deferred prosecution agreement, after the RICO convictions, the short position structure in silver futures has not fundamentally changed. The concentration of short interest remains historically elevated. As of the most recent Commitments of Traders report released by the CFTC, the 4 largest commercial short holders in silver futures control a net short position of approximately 287 million ounces. 287 million ounces of paper silver sold short by 4 entities, against a global annual mine supply of approximately 820 million ounces. The 4 largest shorts on COMEX have sold, on paper, 35% of an entire year of worldwide silver mine production. This number doesn't exist in a fair market. Now connect it to the Shanghai premium data, because this is where the east versus west divergence becomes impossible to explain away. While COMEX paper silver has been range-bound between $30 and $33 for the past 3 months, Chinese industrial buyers, solar panel manufacturers, electronics manufacturers, the battery supply chain building out at scale, have been paying persistent premiums to secure physical silver. The SGE's 99.99% silver contract has traded at an average premium of $2.12 per ounce above COMEX equivalent London spot for the past 60 sessions. 60 sessions. The West is still pricing this like 2019. Let me show you why that matters with a single number. China's solar industry alone consumed approximately 232 million ounces of silver in 2024. Not for investment, not for jewelry, for photovoltaic cells, for solar panels. That single end use, one sector in one country, consumed more than 28% of total global silver mine supply. And China's installed solar capacity target for 2025 and 2026 has been revised upward twice in the last 8 months. The industrial demand machine is accelerating. The mine supply response is, at best, 7 to 10 years behind because you cannot build a new silver mine in 18 months. The geology doesn't cooperate with quarterly earnings calls. And here's what they filed at 3 a.m. that nobody is talking about. The Silver Institute's most recent demand data, released without fanfare in a midweek press release, shows that total global silver demand in 2025 hit a new all-time record for the third consecutive year. 3 consecutive years of record demand. That's not a trend. That's a structural shift in the metal's consumption profile. Meanwhile, primary silver mine supply, silver mined specifically for silver, has been declining since 2016. The vast majority of new silver supply, roughly 72% of it, comes as a byproduct of copper, zinc, lead, and gold mining. That means silver supply is fundamentally captive to the price economics of other metals. You cannot simply incentivize more silver supply with a higher silver price, because most of the supply decision is made by copper miners and zinc miners who are looking at copper prices and zinc prices. The supply structure and the demand structure are moving in opposite directions, and the paper price hasn't reflected it. Why? Why did JP Morgan reclassify 13 million ounces overnight? Why do 356 paper claims exist for every real ounce? What happens to your savings when this ratio collapses? Look at the historical precedents one more time, and the answer becomes clearer. In 1979, the Hunt brothers' attempt to corner the silver market exposed just how thin the physical layer of the market actually was. When silver ran from $6 to $48 in roughly 12 months, the response was the same. Exchange rule changes, margin hikes, emergency position limits. Not because the Hunts were wrong about the physical scarcity, but because the paper system could not survive a full physical delivery demand. The exchange changed the rules mid-game. They allowed only liquidation orders, not new long positions. They protected the short side. And after the collapse, from $48 back to $10, who was left holding the physical silver? Not retail. Not the retail investors who panic sold paper at $15 on the way down. The physical metal that had been accumulated during the run-up remained in the hands of those who understood what it was. The wealth transferred. It always transfers. From the panicked to the patient. The premium held through the entire dump. In 1980, the paper price collapsed. The physical premium for immediate delivery never went to zero. Because the people who needed the real metal, the industrial buyers, the jewelers, the fabricators, didn't care what the paper price was. They cared whether they could get the physical ounce. And that's the exact same dynamic you're watching right now in the Shanghai premium data. Now, pause here for just a second, because I want to acknowledge something. Someone watching this right now is saying, okay, but silver has been about to explode for 20 years. Every few years, someone makes this argument and the price goes nowhere. I hear that. It's a fair point. And here's what I'd say to it. The ratio between gold and silver, the gold to silver ratio, currently sits at approximately 88 to 1, meaning it takes 88 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages closer to 55 to 1. In ancient monetary systems, it was legally fixed at 15 or 16 to 1. When the ratio has spiked to these elevated levels before, in 1991, in 2003, in 2016, and most dramatically in March 2020 when it hit 125 to 1, what followed was always a period of silver outperformance relative to gold. Not because of conspiracy, because of math. An artificially wide ratio closes. It always closes. The only question is the speed and the direction of the closure. In 2020, after the ratio hit 125 to 1 in March, silver went from $12 to $29 in 5 months, a 140% move. Gold moved 25% in the same period. The ratio compressed from 125 to 1 down to 70 to 1 in 5 months. 5 months. We are currently at 88 to 1, and the physical demand data, the East-West premium divergence, and the shrinking registered COMEX inventory all suggest the setup today is more structurally supportive than 2020, not less. Subscribe to The Hidden Economy right now, because what I'm about to walk you through in the next section, the implications of what happens when this ratio move happens simultaneously with a dollar debasement cycle, is something you need to understand before it's priced in. If you find value in this kind of data-first analysis that the mainstream ignores, Hit subscribe and share this video with one person who needs to see it. Most people will never see this information, but you're seeing it right now. Let me tell you who gets hurt when this breaks. And I want to be clear about what breaks means, because I'm not talking about the end of the financial system. I'm talking about something more specific and more immediate. The repricing event that happens when the paper to physical ratio becomes impossible to sustain. 3 types of people are watching this right now. Type 1 is scared. They've been hearing about silver manipulation and dollar collapse for years, and they don't know what to do with the information. Every time silver rallies, they're afraid to buy because maybe it's already too late. Every time it falls, they're afraid to buy because maybe it falls further. They're paralyzed by the noise. They're going to watch this video, feel the urgency, do nothing, and 3 years from now, they're going to be at the family barbecue saying, "I knew about that. I watched a video." Type 2 is confused. They own some silver, maybe a few rolls of American Eagles or a couple of silver bars, but they don't understand the mechanisms. They know the manipulation narrative at a surface level, but they couldn't explain the COMEX warehouse report if someone asked. They're not sure whether to add here, trim here, or just hold and wait. They need the framework, not just the conclusion. Type 3 understands the ratio. They know that once you understand the ratio, the price action makes sense. They see the $30 silver price not as a failure, but as a gift, as the paper market doing them the favor of offering them physical metal below fair value before the repricing happens. Type 3 isn't fearful. Type 3 is strategic. And if you've made it this far into this video, I think you either are Type 3 or you're about to become Type 3. That's why you're here. So let's talk about the implication. What actually happens? There are 2 ways the paper to physical divergence resolves. Only 2. Either the physical price comes down to meet the paper price, meaning physical demand collapses, industrial users find substitutes, investment demand evaporates, or the paper price rises to meet the physical reality. Let me show you why the first scenario is essentially impossible given current data. Industrial silver demand is structural. You cannot manufacture a high-efficiency solar cell without silver paste. You cannot build the electrical contacts in an electric vehicle without silver. You cannot produce the antibacterial coatings in medical devices without silver. The idea that industrial demand collapses at current price levels is not supportable. Solar installation targets from China, India, and the EU alone commit those economies to consuming more silver than current mine supply can deliver, at any price in the current range. The demand is mandated. It's written into national energy targets. So the resolution is a price adjustment, not if, when. The variable is timing. And the timing variable is exactly where the manipulation narrative stops being conspiracy theory and starts being risk management. Because if you accept, as the DOJ's own filings confirm, that concentrated short positions have been used to suppress paper prices before, then the question is not whether the price is being suppressed. The question is whether the shorts can maintain suppression long enough to cover, exit, and let the price adjust without the market understanding what just happened. Here's what they filed at 3 a.m. that nobody is talking about. The Bank for International Settlements, the central bank of central banks, publishes quarterly derivative statistics that include precious metals positions. The most recent data, released without analyst fanfare, shows a $64 billion increase in gross gold and silver derivative positions held by globally significant financial institutions in a single quarter. $64 billion. Moving into precious metals derivatives at the institutional level, in the same period that retail sentiment towards silver is near a 5-year low, institutions are building positions. Retail sentiment is cold. Wall Street is not confused. They know exactly what this means. The premium held through the entire dump. It held in 2011 after the CME margin hikes. It held in 2008 during the financial crisis when paper silver fell to $8 and silver eagles were trading at $14 plus because dealers had no inventory. It's holding right now in Shanghai while COMEX paper sits range-bound. The physical premium is the market's immune system. It's telling you what the paper price cannot. Now let's talk about the dollar context, because you cannot understand the silver setup without it. The US dollar index has declined approximately 8.4% since its most recent peak. That's not a crash, that's not a dollar collapse, but it is a persistent, directional, multi-month move lower in the world's reserve currency. And it's happening simultaneously with foreign central bank gold purchases that broke all-time annual records in both 2022 and 2023 and came within 3% of those records in 2024. The de-dollarization narrative, which was dismissed as fringe thinking 5 years ago, is now covered in the Financial Times, The Economist, and cited in Federal Reserve white papers. It's not fringe, it's policy. And in every prior period of dollar weakness and reserve diversification, silver followed gold with a lag and then outperformed gold on the percentage move. The West is still pricing this like 2019, but the East stopped pricing it like 2019 14 consecutive sessions ago. So who gets hurt? First and most obviously, the holders of paper silver with no physical backing. If you are in a silver ETF, SLV, SIVR, any of the major paper products, you need to read the prospectus carefully and understand that those instruments carry counterparty risk that physical metal in your possession does not. I'm not telling you to sell paper silver. That's not financial advice. What I am telling you is that there is a documented, proven history of paper silver prices being decoupled from physical silver prices during stress events. That gap can last days. It can last months. During those windows, your paper product may not behave the way you expect it to behave. Second, leverage traders on the wrong side of the futures market. When a repricing event happens in silver, it doesn't telegraph itself 2 weeks in advance. It happens in a 72-hour window of margin calls and forced liquidations that briefly make the price move look like chaos. The March 2020 silver move from $14 to $18 happened in 8 trading sessions. The June 2019 move from $14.50 to $17.50 happened in 12 trading sessions. Anyone holding leveraged short positions through those windows was hurt badly. The current short concentration, 287 million ounces held by 4 entities, represents a potential short squeeze magnitude that would be unlike anything in the modern silver market. Why did JP Morgan reclassify 13 million ounces overnight? How can 356 paper claims exist for every real ounce? What happens to your savings when this ratio collapses? These are not rhetorical questions anymore. They are risk management questions, and the answers have a deadline. Here's the honest counterargument, the bear case, because I told you I'd give it to you. The bear case for silver says, deficit reporting and tight inventory data have been a feature of the silver market for 3 years running, and the price hasn't done anything spectacular. The bear case says Chinese industrial demand could slow if the property sector continues to contract. The bear case says a risk-off event, a market crash, a recession, could crush all commodities simultaneously, and silver would not be immune. These are real arguments, I don't dismiss them. But here's what the bear case cannot explain, the Shanghai premium. Because if there were genuine excess supply in the physical market, Chinese industrial buyers would not be paying $2.12 over spot for 60 consecutive sessions. They would wait. They would buy cheaper. The premium is real and it's persistent, and it tells you something about the actual physical supply-demand balance that the COMEX paper price does not. Once is accident, twice is coincidence, 3 times is policy. This is the part where I want you to sit with something. Because before I get to what I think people in different positions should be thinking about, I want you to understand the full weight of what this data represents collectively. You have a 356 to 1 paper to physical ratio on COMEX. You have 47 consecutive days of registered silver inventory drawdowns. You have a mysterious overnight reclassification of 13.1 million ounces filed at 3 a.m. You have a 60-session persistent Shanghai premium of $2.12 above spot. You have 3 consecutive years of record global silver demand. You have declining mine supply since 2016. You have a gold to silver ratio of 88 to 1, historically elevated. You have $64 billion of institutional derivative positions moving into precious metals in a single quarter. You have DOJ-confirmed market manipulation by the largest short holder in the history of the market. Any one of these data points in isolation is interesting. Together, they form a pattern that has a name. It's called the setup before the move. And the people who understand this setup are not posting about it on financial social media. They're quietly accumulating physical ounces below $33. This is not financial advice. Your money, your decisions. I am not a registered investment advisor. I'm an analyst who tracks public data and connects the dots that the mainstream ignores. What you do with this information is entirely your choice. But I'll tell you what I would be asking if I were approaching this cold. If you hold physical silver, the data does not suggest panic. It suggests patience. The registered inventory is declining. The Shanghai premium is holding. The ratio is historically wide. Your ounces are not going anywhere, and the structural demand case is not weakening. The hard part of holding physical metal is enduring the paper market's artificial price signals. But paper says one thing, and the vault says something different. You know which one you own. If you hold paper silver, ETFs, streaming royalties, mining shares, understand the counterparty dimension. Mining shares have their own operational leverage that can work for or against you. ETF counterparty risk is a documented feature of stress events. That doesn't mean sell, it means understand what you own. If you're on the sidelines, the gold to silver ratio at 88 to 1 is historically expensive gold relative to silver, and it has always reverted. It has reverted from every spike above 80 in modern history. If you believe the reversion thesis, the math currently favors silver over gold for the next ratio compression move. That's not a price prediction. That's a statistical observation from 50 years of ratio data. And if you bought at the top, if you bought at $28 or $29 or $32 on the last move, the data I've walked you through today is your argument for patience, not panic. The thesis has not broken. The paper to physical divergence has not narrowed. The Shanghai premium has not disappeared. You are in a paper-suppressed price waiting for physical reality to reassert. That's an uncomfortable place to sit, but it's not a wrong thesis. It's an early thesis. And in markets, being early and being wrong feel identical, until suddenly they don't. Subscribe to The Hidden Economy right now. Share this video with one person in your life who is trying to figure out whether the silver story is real or noise. Tell them you watched something that connected the dots in a way that the mainstream doesn't. Most people will never see this analysis. They're going to learn about this eventually, after the move, after the repricing, after the ratio compresses and the Shanghai premium disappears because the COMEX price finally caught up to physical reality. The question isn't whether this happens. The question is whether you understood it first. Drop a comment right now and tell me, do you own physical silver, paper silver, or nothing yet? I read every comment. I want to know where this audience stands. Tell me wake up if this video changed how you see the market, because I'm going to come back to this comment section when the move happens, and I want you to be able to say you saw it coming. Hit the like button. It helps the algorithm surface this analysis to more people who need to see it before the information is priced in. Hit the notification bell, because the next video in this series is going to cover something that almost no one is tracking right now, the LBMA silver lease rate data, which just spiked to a level not seen since the 2011 peak. The lease rate is the canary in the coal mine, and the canary just started singing at a frequency that serious traders know how to read. Screenshot this, hold me accountable, save this video. Come back in 6 months and tell me whether the paper to physical ratio held at 356 to 1, or whether it broke. The paper market and the physical market are telling two completely different stories about silver right now. Two different prices, two different realities. One of them is right. Wall Street is not confused. They know exactly what this means. The next COMEX warehouse report drops on the first Wednesday of April, March 31st to April 4th window. The next CFTC commitments of traders data is due Friday. And a major silver mining company with significant COMEX delivery obligations reports earnings in the second week of April. 3 data points, 1 window, and the question that's going to define which direction silver moves through that window is the same question I started with. If 356 paper claims exist for every real ounce, what happens when even 1% decide they want the real thing? This is not financial advice. Your money, your decisions.